should have already registered for the GARP website and the Seeking Alpha. You should be receiving articles. Hopefully they're not too inundated, but I just received an article this morning on China, on the stock market, the bond market, Hillary's health, a lot of the EU deciding to maybe raise or lower interest rates. I think they're lowering interest rates. So all of the major factors that are moving the market. Now, we didn't talk about the market, but the market was down 400 points on Friday, and the 10-year Treasury looks like it's approaching 1.7. So once we started tracking it in this class, it was around 1.57. Now it's about almost 1.7. It's a major move in the 10-year Treasury in anticipation of the Fed's meeting. There's a lot of news coming out, and if interest rates do rise, the market will definitely correct on bond prices, and maybe even real estate prices. We're not going to go over the trading game today. We don't have time. I did go over the format of the memos in detail, not only on the format, but I also gave you examples of memos. Does anybody still need any examples of memos so that they're totally clear on the formatting? Anybody need any additional emails, samples for the memo formats? We went over the trades, the price forecasts, up, down with the derivative trades. We reviewed the derivatives, we reviewed the technical analysis, we went over the bullet points and the data that will be in the memo. The data that needs to be in the bullet points, I need to see numbers, okay, and the numbers should be bolded within the memos. I've already had people come by and see me in regards to the memos. What we're going to do today is we are going to go over financial product innovation and engineering. You hear in corporate finance a lot the financial engineering of the balance sheet, financial engineering of the income statement, financial engineering of products in finance, bonds, stocks, the derivatives are all basically engineered product at the end of the day. So we could basically be the financial engineering people in the engineering department. It's the same methodology in designing products over in the engineering department as it is in designing products in the financial services industry. We design products and process to basically solve problems. If we can't find the product or the tool to solve the problem, we create it. Or we piece other products together to come up with a solution. That's all we are, really, solutions people. What we're also going to do is we're going to go through modern portfolio theory. You may want to write these down so that you have the notes. We'll go through MPT, or modern portfolio theory. Okay, and I will introduce the portfolio because diagram and the economics, because the book doesn't have it. They talk about portfolio standard deviation, but they don't lay out the graphics around portfolio diversification. Okay, so the book's missing a part of it. Okay, they talk about it, but they don't illustrate it. Okay. We will also go through yield curve dynamics because all securities, bonds, stocks, real estate, you name it, is priced off of the yield curve, which is basically U.S. Treasury securities, interest rates by maturity. Okay, it's the curve. All right, and again, all stocks, all bonds, all real estate, all swaps, all option contracts, everything's priced off of the yield curve. Okay, and the yield curve has been the #1 predictor of a recession going back over the last 20 years. So you should be watching it. You got to understand what the Fed's doing. I'll walk you through the yield curve dynamics. I'll walk you through theory, the shapes of the curves, and then I'll show you a website, which is the dynamic yield curve. That walks you through, and you can watch monetary policy in action and how it actually creates and pops stock market bubbles. Okay, and then we'll go through some intrinsic valuations, the methodologies that we talked about, perpetuity model, Gordon growth model, the multiple model, and the discounted cash flow. And that will set us up for basically a solid foundation. Also to then start going into the lab and the problems and the book for next week, and then we'll come back, we'll get into the second half of the class, and we'll basically integrate the finance theory together and walk you through from yield curves all the way to discounted cash flows and how they all relate together. I'll do some examples in the second half of the class on securities valuation. So if you have any securities you want to value, bring them to me, and then we'll make them as exercises for the class to start the process of your valuation and being comfortable with valuations. And then the last part of the course will be really focused on application and analyzing the two big banks. You know, I told some of you that we were going to do Deutsche Bank, and they said, God help you, okay, because it's going to be really hard. Okay. It's easy to do some of the other firms, but it's even going to be harder to do Wells Fargo, because Wells Fargo just got slapped with a $500 million lawsuit for basically scamming customers into opening accounts at the bank, and they fired 5,500 people in the process. Tarnished their brand significantly in the process, and I would be interested to see how the stock price reacted to that news. So let's keep going on the final product, innovation and engineering. Your book basically lays out the corporate finance, but a lot of those tools and techniques were basically innovations, processes that were developed by individuals and teams, by corporations, intellectual property, and then those products and processes were commercialized, and then standardized, and then distributed into the marketplace. The product development was either done mainly because of needs from the marketplace or from regulatory pressures or market pressures. At some point in time, the corporations have to do something about it. Financial institutions have to do something about it because the customers are demanding the solutions. And again, if the processes aren't developed, you have to develop them. If the products aren't developed, you have to develop them. If the products are not developed, then maybe you piece other products together to put together the solution. Okay? So now what we're really talking about is marketing and operations. Okay? Marketing and operations, but applied to the finance field. Now, it's going to be a financial product, innovation, I'm just going to abbreviate all this stuff, and engineering. The first cause of financial innovation and process innovation in the finance field, and again, a lot of this now is being accelerated due to advancements in technologies, computing, storage, and telecommunications. So the finance field has changed significantly over the last 20 years, and it's accelerating machine language and automation in technology. Because one of the biggest problems with the markets right now, the reason for the 400 point drop, it was automated trading. The machines took over and did selling. The machines did. It's not people who are driving the markets anymore. It's basically engineers and software and programming. The machines are taking over. So environmental changes. So the corporations are constantly, these financial institutions are constantly scanning the marketplace, constantly monitoring the marketplace, in contact with their clients constantly, and trying to read the market and the demand for financial products and processes. So you're constantly scanning the marketplace. And the pressure just builds also. The markets advance, changes occur, regulatory changes occur, and the pressures on the financial institutions to change and innovate are constant, and at some point in time, they have to change. They have to reorg, restructure, and then they have to develop new products and services to grow their revenue streams. So one of the biggest changes to organizational and industry structures is regulation, okay, is regulatory change. Now, Sarbanes-Oxley was the first, Dodd-Frank was the second. Okay, and Dodd-Frank was huge. More regulation, more audit, more scrutiny, more capital requirements, more on-site compliance visits, more regulatory visits, reorganizational change by financial institutions under Dodd-Frank due to the financial crisis. Dodd-Frank was the regulatory response to the financial crisis. If you look at these financial institutions, pre and post Dodd-Frank, they look similar to each other, but they've reorged. Okay, they don't have proprietary trading units anymore. They don't have off-balance sheet trades. They don't have off-balance sheet, strategic alliances with other corporations. Now they're more real estate lending and investment management focused. And any trades that they're making on their book they're hedging off risk as opposed to trading to make money through proprietary trades. So they've reorged. And a lot of the top people within these financial institutions were traders at one time, and now they're being replaced by investment managers and other types of individuals, bankers. So there's even a cultural shift and leadership shift going on at the top. These environmental changes have major impacts on industrial psychology within the firms. Not only industrial psychologies, but individuals, and also group psychologies within the firms. It changes the culture and leadership style at the very top. And it'll be interesting to see why Wells Fargo's CEO is to continue to be in place. He should basically have been fired by the board for allowing for the corruption to go on internally in the firm. And the criticism is, well, we really didn't know about it. Okay, I'm not in control with the whole organization. It's a big corporation, big financial institution. I didn't know about it. Well, Elizabeth Warren would basically say, well, if you can't control your own company, you're too big, and you're too big to fail, we should dismantle you. Okay, so you'll see some changes going on. Obviously, when you have environmental changes and organizational changes, you have to change your tactics, your strategy. In the marketplace, you've got to change your operations, and you got to change your planning process. Due to environmental changes, you have to constantly be doing competitive market analysis. Looking at the competition, and again, the top 5 banks control 50% of the assets in the United States. Goldman, JP, Wells, B of A, Citi, they control 50% of the assets in the United States. They're an oligopoly. They're extremely competitive. They're trying to invent new products and processes for their clients, steal clients away, and grab market share, along with trying to invent new products and processes to grow revenues over the long run. Okay, that's the name of the game. It's totally brutal. So they're trying to grow not only revenue internally, or earnings internally by lowering the cost structures through technological implementation, but they're also trying to grow revenue through new products and services, and they're also trying to grow revenue through market share. Okay? This is constant, and this is continuous, okay, at all times. Process, product, innovation. Total implementation and integration of enterprise level systems. Enterprise resource planning, or ERP. So now you have the systems and ops people constantly reviewing the flows and the channels within the organizational structure to try to see where the resources are for the redeployment, but also optimize the resource allocations for productivity gains. So ERP. This process, product innovation and process innovation, is constant and continuous. Constant and continuous. constant, continuous product development. Constantly looking for new processes to exploit, streamline, and new products to develop, to bring to the marketplace, get it adopted, and scale it as rapidly as possible to generate the revenue streams. And that process is shrinked and becomes shorter and shorter over time due to technologies and just the focus on process, redesign. So ERP. The other is you need to recognize client and customer needs. Globalization created multinational corporations. They had major needs for forward contracts in currency, and interest rates, swap contracts. You have to be able to identify the wants of the clients and then be able to meet those needs. You have to be able to design the products that have the attributes to meet the needs of the clients. New York Life invented the guaranteed future income annuity because people were scared from the financial crisis. They wanted guarantees. They invented a product that guaranteed them basically a payout for the rest of their life. They invented an annuity product that basically guaranteed that they wouldn't lose any money within the portfolio in the contract. That's innovation. New York Life on the guaranteed future income annuities, they control 40 to 50% of the market through that product design, product adoption, product introduction. It's scaled and got adopted. They control 40% of the market. Now they own 50% of the market. They only own 40 now because more entrants have come into the marketplace and taken the market share. So constant product design, development through R&D. Your research department, your design department, engineering department, research and development, R&D. So you're constantly plowing back retained earnings back into the corporation for R&D for constant process and product development. Yes, sir.
What is B? I can't.
Which one?
Rec, client.
Oh, you need to recommend client and customer needs. Sorry about that. So you're constantly surveying the marketplace, constantly listening to your clients, and the sales team are on the front line, and they're bringing back the ideas to the design teams and senior management, and then they work for months or maybe a year to design the product and then do a product launch. Okay, particularly for the annuities was a big deal. So you have to look at the product attributes. For example, the guarantees and the annuity contracts, the returns on the stock portfolios. What are the attributes of these products? And can the product attributes actually be executed on? Backed by the sponsoring financial institution, but do the product attributes, are they actually executed on? Do they actually work? Because obviously you can design and produce defective product. There's a lot of defective product out there in the financial industry. It depends on who the sponsoring financial institution is and what the product attributes are. So you gotta read the contract, okay? And what are the attributes in the contract? And what does the sponsor have to adhere to meet the need? It's got to solve problems. Biggest problem, running out of money. Running out of money because you retire too early, you don't have enough savings, you run out of money, you're done. That's the biggest, one of the biggest problems. The other is market volatility. I cannot live through a 2008, 2009 scenario. Again, my portfolio went down 40, 50%. if I'm in retirement, my portfolio goes down 40–50%, I'm having less money to be able to rely on for retirement, I run out of money, I'm done. So market risk is one big component, running out of money is another, guarantees is another, and then the quality of the products. I'm willing to pay higher fees for higher quality. So I'm willing to pay the fees or the management fees to buy a product that's gonna perform, that's gonna give me the guarantees, that's gonna make sure that the cash, it comes to me over my lifetime, and the sponsoring institution does not basically default on their promises. Okay, so there's a lot of trust in these institutions. 3, product production and distribution. Now, these large financial institutions, particularly the top 5, along with Goldman Sachs, can produce the products very quickly and distribute it through their marketing channels to their affiliated branches, broker-dealer networks, and can get it done in a very short period of time. Charles Schwab came out with a equity mutual fund some years ago when I worked there. They were able to raise in 48 hours basically $5 billion, okay, within 24 hours, because they have the distribution network. They have not only their branches and their advisors, but Charles Schwab, along with TD Ameritrade and Franklin and those guys, basically provide platforms for registered investment advisors to run their books off of and their advisory services off. So it went out to thousands, 100,000 advisors, and the advisors basically marketed that new product to their clients and was able to sell and bring money in very large amounts with very little time. That was a successful launch of a product. So being able to produce the product and distribute it quickly is the key. So you want quick product introduction and distribution. So the large banks and broker-dealer networks have that ability. You have to be able to look at the marketing mix, and you have to look at the channels in which these products are being marketed. Advertising, social media, broker-dealer networks, investment advisor networks. Doing a lot of the marketing for you, and there's different channels and different mixes associated with that. And there's an optimal mix on the marketing side that you have to come up with. You have to look at the product supply chain. Are there any inputs into the distribution process? Do you need other inputs into the process, other affiliates into the process, to be able to, are there any supply chain dependencies? And you're gonna have to manage the production. And the supply chains. You have to look at your distribution networks, optimize those, use the telecommunications and the technologies to be able to distribute out, to let everybody know that there's new and available product available to you, and push them out through the, particularly the social media networks, okay, to let everybody know what's going on. You need sales. You need sales teams. You need clear communication. On the product attributes. You need to communicate and find out the client needs, and then fashion the wording to be able to instill either fear or greed, which are the two main motivators of people, to get them to act and react, ideally in their own vested interest. Those clients that I've worked with actually make decisions against their own self-interest. Larry, I appreciate the knowledge, I appreciate the advice, I don't have time right now. I gotta talk to my wife, I gotta see how much money I have, we're going on vacation, we can't do it right now, and they never do it. And then they come back to me and they say, hey, I remember when you came back to me and asked me, you know, telling me about that portfolio strategy and the tax strategy and the trust strategy and the insurance and the annuity products that you were, you know, telling us about. Can we still do that? No, you're too old, you got sick, you don't have enough money now. You know, things happen in the life and people miss a lot of opportunities because they just aren't motivated or they just don't trust the financial institution, they don't trust the product, and they don't trust me. So those are the biggest obstacles to the sales process. So trust. Trust is huge. Reputation. And then driving the client through the sales cycle. So you gotta be able to do the prospecting, you gotta do the market identification, market segmentation, identify the clients by segment, by age, by income, by race, by culture, whatever it is, and then fashion the communications to the individual market segments to then be able to communicate to them, to bring a value proposition to them, to communicate that value proposition to them, to overcome the obstacles associated with brand and company and personality, and then to be able to drive the client to be motivated to take action, and then to be able to close the transaction, okay, and take them through the closing process. So you gotta take them through the sales cycle. And this is really key right here, because the biggest complaints by industry for our students and other students is they don't understand the sales cycle. They don't understand the sales process. I'm not going into sales because I'm going into accounting and finance, I'm gonna be an analyst, I'm not gonna be selling, so I don't need to understand this stuff. That's totally ultimately wrong. Because at some point in time, you may be pulled into a sales role or a business development role properly, hopefully, and you're gonna need to understand the sales cycle process, okay? So it's another disconnect between academia and industry. Number 4 is gonna be business development. Marketing, and sales. Of the financial products. And financial products are harder to sell because they're intangible when you have objections against the sponsor, the product, and me. So they're harder to sell, they're not tangible, they're not physical, they don't provide physical utility. They fill basically emotional needs and they're intangible. You can't see them, you can't feel them, you can't kick them. You get financial statements, maybe the person calls you on a quarterly or biannual, annual basis to check in, to get you updated and let you know if the product's performed or has not performed. Okay? So it's harder. Marketing. What's the market segment that you're selling into? Is it retirees? Is it people between 55 and 65 years old? Between 35 and 45? Between 15 or 15 and 25? What's the market segment by demographic? By socioeconomic, sociodemographics, you have to segment the market and figure out where the market is. And then align the messaging and the products with that market segment and figure out if there's a market there. Is it an unmet market where there's no products or anybody servicing that market segment, which could be an opportunity? Or is it a saturated market segment where you're competing against everybody else and you're just a commodity competing in the market space? Target markets. Oops. Once you've done the marketing research and figured out the market segments and what markets have opportunity for you, then you have to target market. You got to target those markets and put together the marketing and the messaging. Those markets could be based on psychographics, demographics, sociodemographics, economics, maybe by industry, maybe by businesses, by size, by industry. I've been targeting tech companies and startup companies because a lot of these startup companies have founders in venture capital and seed and angel funding. And a lot of these founders who developed the IP and started the company, a lot of them don't have life insurance. So if any of those guys go BK, gone, the VCs are out $5 million or 25 million. There's no insurance policies in place to backfill the loss of the IP and the individual, to basically bridge the gap, to find another person to come in and take over, or to bridge the gap in the loss of the IP. Okay. So a lot of these companies don't have any hedge against their intellectual capital or intellectual property, from what I've seen. And it's a really hard market to sell into because they're all young and smart, and they're younger and smarter than me, okay, in most cases. Advertising campaigns. Advertising campaigns, again, you gotta be targeting the markets with the right messaging, communications, to overcome the objections through the advertising programs, advertising campaigns. And there's gonna be some kind of optimal mix in the advertising and the marketing that you're gonna use to target the market. Obviously, younger investors, younger demographics, are going to be more inclined to use texting and maybe other forms of social media to communicate, where people in their between 55 and 65 or 65 and 75, phone calls and letters and maybe other forms of more traditional communication devices to be able to do the advertising. And there's lots of regulation around these advertising campaigns, particularly advertising to elderly people and retirees, because they don't have the cognition and they don't have the motor skills. Because it's deteriorated due to either illness or just age. Prospecting for clients. That's the hardest part. It's easy for some who are already have entrenched networks in place due to family and friend or cultural networks, makes it a little bit easier. But if you're gonna go out and you're gonna try to find clients, prospect, you gotta figure out where the people are, and then you gotta make an effort to get there, and then you have to have perfect communication skills to be able to introduce yourself and build a relationship and the trust that you need to be able to engage with them on an ongoing basis. People don't want to be sold to, they want to be educated, and they want to do business with their friends in those cases. So a lot of times you end up becoming friends with these people. So once you do set up and you've identified the prospects, you got to convert them, right? Because you're just wasting money and there's huge opportunity costs associated with going out and trying to get clients. So there has to be a conversion. How many calls do I make per day? How many emails do I send out per day? How many people actually call me back or respond to my email, my calls? How many people that respond do I actually set up with a one-on-one appointment with? How many people do I actually meet with? Of the people that I actually meet with, how many people are actually interested in doing business with me? Of the people who wanna do business with me, how many people actually follow up and I follow up to convert them and move them through the sales process? So there's a lot of, it degrades pretty quickly. And then the only way that you can increase your conversion or your hit rates is through experience and really understanding your market and being able to perfect your communication and to be able to sell quality product that's gonna execute on behalf of your clients. The sales cycle, and what you're looking at for is velocity. How many transactions can I get done? Based on my own physical and technological limitations and my human resource limitations. The more transactions I do, the more money I bring under management, the more products I sell, the larger the fees, the larger the commissions, the higher the revenue. Not only for the company, but for myself as an income. So really velocity, so the number of transactions and scale. Large transactions. Not $1 million life insurance policies, but $100 million life insurance policies. Group life insurance policies of $1 billion for a corporation. Now we're talking about very sophisticated strategies with very sophisticated product applications. Again, all at the finance level. Okay, all at the financial product level. But you gotta layer in the strategy. You can talk strategy, then you can identify the products and the services that you need, figure out the solution, and the larger the scale, the larger the profit, the larger the money that you'll make. You also need customer service. Because what you've already done, if you've already got a client, you've already got them locked in. Once you got them locked in, you got recurring revenue. Not only for the products you've already sold them, but you can also go back to them in the annual, biannual, monthly, weekly reviews or daily calls, depending on the servicing level of the client. But you've already got them locked in. So not only is there opportunities for upselling or reselling, but you already got them locked in on existing products that are creating a perpetual revenue stream. So you already got them. And if you already got them and you're communicating with them, they probably, the people you work with, probably have a referral network that you can take advantage of through referrals. You need to talk to Larry. You need to talk to him. He was great. He sat down with us, with his team, they figured out our problems, they put together a solution, they executed on the solution, they kept us up to date during the whole process. We felt really comfortable, we think that you should work with them too. Okay, so referrals are huge. Okay, and again, your network becomes your net worth. Okay, anybody wanna take pictures of this or anything before I erase it? Next, you have to understand, both at the company and at the client level, are.
Professor?
Yes, sir.
When you go and get referrals from someone, is it a better choice to like pretend like they're a brand new client that you've never talked to, or to say, look, I've done business with the person that
You integrate it into your language. Oh, I'm giving you a call to get you, updated on your account. I want to walk you through it, and then at the end of the conversation, you say, hey, if you're satisfied with, the value that I brought to you, do you have anybody else you think I should be talking to?
So when you talk to those people, do you pretend like they're new clients that you're just first making contact with?
If somebody gives me a referral,
Yeah.
okay, what I'll do is I'll ask them to email the person, text them, or give them a call, tell them that they referred me to them, and make sure that they totally understand, and then ask them if they're comfortable in having me give them a call. Okay, so you really can't screw up, okay, because you're gonna lose the account. So you have to be really careful on how you communicate with people and be totally ethical and moral in the process, because they'll totally know if you're trying to sell them something. Okay, if you're bringing them value, that's great. If they have a need, that's better. But if they think you're just a salesperson calling them to try to get them to buy something, they're gonna reject you, and they're never gonna talk to you again. Okay, so you have to be extremely, and this is for everybody, okay, this is everything. Because we're all gonna be working with people, we're all gonna be working, with clients. This is all best practices. Okay, I'm not inventing anything here, this is just applied to the financial services industry and financial products. So I've taken all of the best practices from marketing and sales and applied it to finance, and financial products, and services. And services are products. So the next is really product, process, technology, adoption, and curves. Okay? And the process and the technology curves are called S-curves. And I will also walk you through the product adoption cycle. All done at the corporate strategy, the marketing, product development level. This is how senior level managers think about it. And you've probably seen this in your operations research course, and you've probably seen it in your marketing class, but you haven't seen it applied to the financial services industry. So really the goal is really industry and company revenue projections. If we introduce this project or product, series of processes and products, how's it going to generate revenue for the company? Okay, that's what they constantly think about. How are we going to generate revenue for the company? What is the impact of the revenue? And can we create a revenue stream or a constant revenue stream into the future to grow the revenues, grow the earnings, grow the dividends, and maximize the stock price or the value of the firm in the process? You've got to understand the revenue projections. So the first model is the S-curves. Developing technologies on a constant basis that's going to create either productivity gains or new products on a constant basis. Introducing technologies. So you got the technology that you're going to develop, and you got basically S-curves, introductions of new technologies. They go through technology life cycles, which are called S-curves. S-curves, you have the early development stages, and then the technologies accelerate the revenues, the productivity gains, and then eventually the products of the processes become obsolete and the technology becomes obsolete due to new technologies and advancements. So you have different technologies, S0, S1, S2, S3. So over time you're introducing new technologies for commercialization and exploitation. And these are your technologies that are being developed. And if you're successful, I think Apple, IBM, Salesforce, you name it, have been extremely successful. Microsoft have been successful in introducing Cisco, introducing new products continuously, or inventing new technologies continuously over time. Different phases, different versions over time. So what you end up doing, if you do it successfully, through successful technological innovation, is you create an upward revenue path, an upward path of new product, process, development, and introduction, and application and exploitation in the marketplace. So those are the S-curves. And the other model is your product adoption cycle, which is key. When you're doing forecasting of revenues based on new product and product introductions, you're going to be asked to be able to project out what the revenue curve is. Okay? And you may have historical examples of financial products that you've introduced in the past, so you get a good idea of what the product adoption curve will look like. And if you don't have paired examples internal to the firm, you go outside the firm and you look for other products and other companies and industries that have introduced products so that you can get an idea of what the adoption cycle is going to look like. How long is it going to take us for this product to get fully adopted, scale, and maximize the revenue? So you're going to start off in the innovator stage. So you're in the innovator stage. You plowed out a lot of money, you've been bootstrapping, you got some seed, we're burning through our capital, we did capital expenditures, we bought equipment, we hired people, we have a lot of sunk costs during this time period. The market hasn't really adopted it yet. It's only been the innovators, the early adopters that have adopted the products. Okay, so it hasn't even been scaled yet. So there's, high costs and the adoption is flat. That's the first phase. The second is going to be early majority adoption, which is the key. That's what you're looking for. Early majority adoption. All of a sudden, your technology takes off. All of a sudden, everybody wants it. Everybody wants that product. The guaranteed annuities by New-York Life. Everybody wants guarantees. Everybody wants it. Everybody rushes to the marketplace to buy it. So at this point, you have exponential adoption. You get scaling. You can scale rapidly. So hopefully you had some good operations planning in place because the worst thing you can do is introduce a product and not be able to supply under the demand curve. Okay. This is your early majority. And this is the key component of your revenue forecasts, or your revenue projections. That's what we're looking for. Do you know how to do that? And again, if you can forecast what the earnings are, the revenues are, or the cash flows, you can discount those back to the present to calculate the present value of the cash flows, the net present value, to accept or reject the project, the internal rate of return, and when we're going to break even on the project. And again, we'll go through that stuff later too. So what happens is during this process is it creates multiples. Anybody heard of unicorns? Anybody heard of unicorns? Yes, no, yes, no, yes, yes. Unicorns, if you look at unicorns, they have very low cash flows, but they have extremely high multiples. The market is anticipating the early adoption phase and the scaling of revenues and the scaling of the production process and adoption by the marketplace.
It says scale rapidly. Is it possible to scale too quickly? Is that something that you can?
With technology now and with the distribution networks in place, you can scale rapidly. The question is, do you screw it up? Okay. If you mess it up and you screw up the distribution and you distribute defective product, you miscommunicate to the marketplace what it is, you mess it up through advertising, you're going to destroy this. Okay, and most early stage startup companies destroy this, because they don't know, they don't have any experience. They're usually run by founders, and the depth and breadth of the advisory board is just not there, okay? So they don't have good advice, and they make mistakes, and it totally screws it up. And what'll happen is they'll burn through their cash, they'll go negative, and the startup will fail, okay? The company will fail, or the product will fail.
Could you define unicorn again as low cash flow?
Low cash flow, unicorns are basically traded in IPO. They're held on venture capitalist books. The companies have a big promise in generating cash flows in the future, but currently they may have zero cash flows or negative cash flows or very low cash flows. So the market value that's being put on these companies is all driven by future revenue multiples.
Thank you.
Yeah, you're welcome. And then I'll get into new venture capital, new venture finance later on. In the semester, I'll do a whole nother lecture on it. So now you're in majority adoption. Basically, everybody who wanted your product has basically fully adopted it. So it's majority adoption. At that point, the question is, when it's got fully adopted, do we keep it or do we sell it off to another company and maximize the value of that income stream? Usually at majority adoption, competitors have started moving in and started competing. Your revenue growth is starting to, it's flat basically at this point. So your cost structures are probably eating into your profit margins at this point also. And then the last phase is the laggard. At this point, these are the last people that held out to buy their iPhone or to buy their annuity or their life insurance. They're very late, it's a really small market, revenues aren't big, and basically your product is pretty much, already fully adopted. So the key is gonna be, can you create a consecutive series of products? 1, 2, 3, over time, to be able to generate an upward sloping revenue curve that will grow earnings at a constant rate into the future to maximize the stock price. So you constantly bringing new products to market, to be able to resell, to create new Hawthorne effects and excitement around the products, to create adoption, to create revenue growth around the scaling of the product, and to do it over and over and over again successfully. Run by very talented and forward-thinking senior executives and divisional heads in the process, and then executed by people, the staff in line, people within the organization. That's the goal. When you're analyzing these projects, I mean, obviously product adoption, marketing, R&D is extremely expensive. It costs a lot of money, opportunity cost, money to develop these products. So you're constantly putting money out to develop these products, to do the messaging, to tweak the attributes, to tweak the designs. There's a lot of effort that goes into it. So, but you have to analyze these product launches. So you have to conduct feasibility. You got to conduct the financial feasibility analysis. And as you're learning in this class, the standard methodologies for financial feasibility is calculating the present value of the cash flow. The net present values, the internal or modified rates of return, and the break-evens on the projects, the product development. So you're going to do R&D, research and development. You're gonna develop, you may acquire talent, but all of that is basically sunk cost. It's all sunk cost. You're going to use technology, S-curve analysis, and the product adoption cycle analysis to be able to then project out the revenue, the free cash flow, which is measured by EBIT, EBITDA in most cases, from the products, the projects. You are going to calculate the present value of the project, product, revenue streams or cash flow streams. You are going to subtract out from the present value of the cash flows, the cost of the product or process development, or the project costs, the acquisition costs, to get to the net present value. If the net present value is equal to 0, you're going to accept it. If the net present value is positive, you're going to accept it. If the net present value is negative, you are going to reject it. Basically, the present value, net present value, along with the internal rate of return, if it's equal to your expected return, you're going to accept it. The internal rate of return is greater than your expected return, you're going to accept it. And if the internal rate of return is less than your expected return, you are going to reject it. If the break even which is basically the cost minus the cash flows over the period, the question is when do you reach break even? In year 1, 2, or 3? In most cases, in established companies with traditional products such as financial products, you may be willing to wait a year, 3 years, maybe. You would rather be able to break even in 2. And in technology products and other types of financial products now with the technologies in place and the distributions, the networks, less than a year. You need to break even in less than a year. If you can't, we're going to discontinue the operations and we're going to discontinue it. You're either going to move the staff over to other projects or we're going to fire them. Okay? And then the last is going to be, and I'll talk about this later, real options. Like the call options that I talked to you about before, but these options are long contracts. And the question then becomes, will this product, does it have an opportunity to spike in the adoption cycle? And if the answer is yes, then this thing becomes really valuable. This real call option value is really big. And if the value of this, if the potential for this product to scale and be profitable and get a lot of money and bring a lot of money in, and we can basically get adoption really quickly. If this real option value basically greater than or equal to the negative net present value, then we are gonna accept it. And these calculations are run by corporations and biotech especially, but a lot of corporations basically do make final decisions based off of this methodology. Okay, and I'll get into the detail on that later. And then the last piece that's really important is being able to, how am I doing on time? Am I out? Huh?
28.
Can you enter the markets very quickly? We see the need. People want guaranteed annuities, they want guarantees in the return, they want guaranteed payouts, they don't want to run out of money. Can you bring the product to the marketplace very quickly? How fast can you do the R&D, perfect the product, bring it to market, scale it underneath the demand curve? So being able to market entrance, and then execution. Can we mobilize our designers and our sales team and our distribution networks to get in place to be able to sell into the marketplace rapidly and execute? And if you screw up the execution, you're gonna disrupt the curve. You may not reach the expectations, and your net present values turn negative, and your project is reduced, rejected, and your product is discontinued or eliminated. And then you also have to have exit. You have to have market exit strategies. When do we go to the next version? Do we discontinue the product? Or do we sell off the divisional line to our competitors because we're done with it? It's worth more to somebody else than it is for us internally, so we're gonna spin it off or we're gonna discontinue it and take the tax write-off. So these exit strategies and entrance strategies, you have to lay out a clearly defined, rules-based approach to getting in and getting out. They did a survey of venture capitalists. Basically 40% of all venture capitalists, when they make investment decisions, are not rules-based. It's gut feel. Yep, they don't have a matrix, they don't have a scoring sheet, they don't have rules-based acquisition, distribution, exit entrance strategies. They do it by gut feel, which is, they're probably making more mistakes and losing opportunity by doing that. Or it's so profitable of an industry that it overcompensates for their myopic and their incompetency in decision making, which is that's probably the latter. So you gotta have a rules-based approach. You have to have metrics in place to enter and to exit the market. So you need to have the metrics designed. You have to be unemotional. You can't get emotional. You can't get emotionally, attached to the product, or the process, or the people. It's got to be an unemotional decision based on metrics, based on the mathematics. Okay? No gut feel. And then the ultimate decision is going to be divestiture, spin off, maybe IPO. Is it successful? Basically, the product, process, the division has exceeded its expectations. It is worth more in the public markets as a publicly traded company as opposed to an internal division to the company. We can do a capital event, and we can monetize the value of the division by taking it public as an initial public offering. How much time do I have? Yes, sir.
18. What are the strengths of being a private company compared to like an IPO and become public?
Private companies do not have to disclose their financial statements, only to the investors that are participating within the company. They don't have to report to the SEC. They do not have to use GAAP accounting standards, although they probably do. value of the company doesn't fluctuate due to the fluctuations in the stock and bond market. And you don't have basically analysts and the media crawling all over you when you make quarterly reports and annual reports. So you're more immunized, okay? But the private firms can basically buy up public companies, take them private, they can go public if they want to at some point, they can spin off divisional lines as public companies and then hold their shares. They can do a lot of things. Okay, any other questions? No? Okay. All right, so that's basically that. I will start on the portfolio theory and get as far as I can and then just remind you where we left off. Okay? And then we'll try to get into your curves and stuff like that. So I developed this model, these models, probably, I don't know, 2 years ago. So I started to really get into the finance and the financial product. So and again, you know, you're not gonna learn this in a marketing class, and you probably won't learn this in a traditional corporate finance class, or any finance class at all, because this is never really discussed. Probably discussed maybe at the executive MBA level or an executive program level, very focused. So I hope you appreciate the effort. The next model is gonna be modern portfolio theory. What is called MPT, which was designed by Henry Markowitz in 1957. He wrote the book and the algorithms, and it wasn't until the mid-80s that with the advancement in processing technologies, and chips, and flash drive, flash memory, that the computers could actually do the computations, because they were so computationally intensive. And now a lot of these computations are done in the cloud and processed in the cloud. And the speed in which the calculations can be done in minutes now, when it took hours and days to do the calculations. That's why I made you do the covariance and the correlations. Imagine you have a 100 stock portfolio that you're trying to manage, and to calculate the covariances and correlations and the returns on 100 stocks all in a factorial combination would be impossible to compute. It was impossible to compute prior to 1985 and recently. So the line that comes out from the origin, the y-axis, this is going to be expected return on the portfolio. So it's a weighted average of the returns on the bonds of the stock or the real estate that's in there. So it's a pretty straightforward calculation. And then on the x-axis, you have the portfolio standard deviation, which you already have calculated. Okay, so you understand the importance of correlation and covariance in the calculation of the portfolio standard deviation. Okay. The line that comes out starts from the risk-free rate, which I would use the 10-year treasury, which is roughly about 2%. And the line that comes out is called the capital allocation line. There is an umbrella. Which basically states that I can put together a portfolio of combinations, in this case between stocks and bonds, of any combination that is actually feasible to be constructed in the marketplace, in the capital markets. I can put together a 100% stock portfolio. Obviously, I'm going to be taking a lot of risk, but I'm also going to be compensated with higher expected returns on the stock portfolio. I can also put together a bond portfolio. And yes, I'm gonna be taking on less risk, but I'm also gonna be receiving lower expected return. Now, I can, if I want to, if I'm willing to take on more risk to get a higher rate of return, I can sell off my bonds and buy more stock. So what I'm gonna do is I'm gonna reallocate the portfolio, reduce the allocation to bonds, and increase the allocation to stocks. I can also reduce the risk within my stock portfolio. Yes, I'm willing to take a lower return, but I'm also gonna reduce the risk. So I can start selling off and reallocating my stock within my portfolio, start buying more bonds, and reduce the risk, but also reduce the return in the process. What I can do too is at this tangency point, okay, this tangency point where the capital allocation line and the efficient frontier are tangent, where they meet, that is the point what is called the market basket. So it's basically look at the total value of bonds, the total value of stocks, you add them together, you divide it back and get the percentage. So historically, the market portfolio between the two assets was 70% bonds and 30% stock for the market basket. Because the value of the bonds were basically significantly more than stock because people issued more bonds than stock because you have the tax deductibility in the interest on the bonds. And bonds have the first claim on the cash flows over the shareholders. So there's an incentive to issue more bonds over stock. And you can lower your cost of capital because of those features. The cost of bonds are cheaper than the cost of equity or stock. Now, investors would love, if they could, to be up here. This is their utility function. They want low risk, and they want a high return. Well, there's no investments in the marketplace there. So what the investors need to do is they need to lower their utility to get to the portfolio that's available in the marketplace. Because there's no stuff up here. So they have to reduce their utility to get to the market. And where the utility curve, capital allocation line, and the efficient frontier umbrella are tangent to each other, that's the market basket. That's where the market preferences match the available portfolio and the composition of the marketplace. At this point, at the market basket, you're going to have portfolio risk and the expected return on the portfolio. The expected return to risk ratio is going to be maximized. Okay? That's why I made you do the inverse of the coefficient of variation. So you're going to maximize the risk-adjusted rate of return. Most institutional investors and risk-averse investors want to maximize their risk-adjusted rate of returns. Most institutional investors and risk-averse investors want a target rate of return of 8% to 10%. No more, no less. Why? Because they can double their money, based on the rule of 72, they can double their money in less than 10 years. That's what they want. That's what they target. That's where the bulk of the capital is in the marketplace. So the goal is to diversify get the target 8 to 10% and diversify the portfolio to reduce the portfolio standard deviation and increase the risk-adjusted rate of return. That's the key. I can get the target, I can reduce the risk, and my risk-adjusted rate of return is gonna go up. If I can do that as a manager in a company, more assets under management will flow into the corporation, into the financial institution. You gotta keep me on track on time. Okay. So, what I can do also as an investor is I can juice the returns on the portfolio. I can actually jump off the efficient frontier and move up the capital allocation line by taking on leverage. So I'm going to margin my stock portfolio, buy a margin, borrow money from the broker-dealer, use the broker-dealer's money, me put up a little bit of equity, I'm leveraging up my rates of return. Yes, I'm gonna get more return, but I'm also gonna be taking on significantly more risk. I can also leverage up my real estate portfolio by taking on mortgage. Using the bank financing to lever up my equity. I can also jump off the efficient frontier down here, move down the capital allocation line through the process of lending, and that's what banks do. Basically lend businesses, collateralized by the business, lend mortgage finance to investors in real estate using the property as collateral for the loan. So if they default on the loan, we take the business or we take the property in lieu of the mortgage or the loan on the business. So yes, I'm gonna get lower rate of return lending, but I'm significantly gonna reduce the portfolio standard deviation. How am I doing on time? I might be able to do this.
5 minutes.
The goal in diversification is to build a portfolio with assets whose returns have no low or negative correlations. I add assets to the portfolio whose returns have low, no, or negative correlation with the other assets' returns. If I can do that, what happens is the efficient frontier bows out. It bows out the efficient frontier. Yes, I'm going to take a lower expected return in the process, but I'm significantly reducing the portfolio standard deviation. And if my expected return on the portfolio is constant, then I'm reducing the portfolio standard deviations significantly and increasing the risk-adjusted rates of return in the process, and that's the requirement for institutional risk-averse investors, which is the bulk of the capital money in the capital markets. So, what causes efficient frontiers to go out? You add cash value, life insurance in your portfolio. You add private equity real estate, and you add alternative renewable energy. These all are the alternative, these are called the alts, and these are called the alternative asset classes. Because their total returns have low, no, or negative correlation with stocks and bonds. And the target allocations, how much time do I have? 2 minutes? Be able to do it. 10%, 10%, 10%, 40% bonds, 30% stock. This is basically the target allocation model portfolio for the next 30 years for institutional risk-adjusted investors. This market is capitalizing, this market's established, this market's established. If it's into the research on life insurance, if it's into research on private equity real estate, and Deutsche Bank Reef did research on renewable energy and came up with the allocations. It's going to bow out the efficient frontier and increase risk-adjusted rates of return. Okay. So we did get through 2. We'll probably finish the other 2 on Thursday, and then we're pretty much done with the first third of the class, and we can start